What we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. And in essence, that's what business is all about. I mean, you may want to be the lord of the castle yourself, in which case you don't worry about that last factor. But what we're trying to find is a business that, for one reason or another, it can be because it's the low-cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage. For any kind of reason at all, that it has this moat around it. And then what we have to decide is all moats are subject to attack in a capitalistic system. So everybody is going to try. If you've got a big castle in there, people are going to be trying to figure out how to get to it. And what we have to decide, and most moats aren't worth a damn in capitalism. I mean, that's the nature of it.
That was Warren Buffett talking about a concept that he calls a moat. He calls it a moat because he used the analogy of a castle and a moat that defends the castle being the company that we want to invest in. Now, a lot of other people call these competitive advantages. Competitive advantages come in many different shapes and sizes, but today we'll be talking about some of the key models and the key examples of advantages that you can look out for. Warren Buffett has named a couple already in the video, but we'll talk about a few more and then examples of companies that have these models that you can sort of reference your companies that you're looking at to these models. As already referenced by Warren Buffett, competitive advantages are crucial for a company over the long term because it stops other companies coming and trying to steal their market share or steal their idea, and it allows them to keep operating at a high margin, a high gross margin or high net margin to other people with a high return on invested capital and a return on equity for a long period of time, because they've got something that's key and competitive compared to other players in the market that allows customers that keep wanting to come back to this company that you've invested in. So they're crucial for long-term investing, and that's why we're going to cover them today. The first competitive advantage or moat that I think we should speak about is a toll bridge moat. Now, a great example of a toll bridge moat is Burlington Northern, which was a railroad that Warren Buffett invested $26 billion into to buy the whole company in 2009. But first, I'd like to show you an interview that Warren Buffett did where he talks about some of the key points about the railroad industry, and then I'd like to talk to you a little bit about how this leads to a toll bridge.
But I mean, he also pointed out, it is said that, there was, this was a regulated industry.
Sure.
This was an industry that was capital intensive.
Very capital intensive.
This was an industry...
you spend money.
It was unionized.
It was unionized. You spend money in this business regularly, every day. You're spending a lot of money, repair track or add rolling stock, whatever it may be. So it's capital intensive, and it is regulated, and it will continue to be regulated. It will continue to be capital intensive.
So as you've just heard from that interview, Warren Buffett describes the industry as being very regulated and very capital intensive, because every day you're spending loads and loads and loads of money on new rail tracks and repairs and everything else. Now, this leads to this toll bridge effect because most companies can't afford to have the upfront cost to go into the railroad industry. Nonetheless, they also can't get into the industry because putting rail tracks actually through the country is extremely hard, and you have to get the correct permission and the correct regulation to actually allow you to have railroads. So what you end up finding is the companies that have already got the railroad set up, they're the ones that are going to keep it. And what it does is it stops new competition from coming in and trying to take the business that Burlington Northern has grown over the years, because companies can't simply come in and spend a load of money. Even if they had all the money, the regulation wouldn't allow them to go and just build hundreds and hundreds and hundreds of miles of new rail tracks all through America, because you've got to plan all these correctly, especially through like urban districts and everything, to actually get the goods and the business to allow their business to grow. Now, this means that they've got a toll bridge. So people have to use their rail lines, or another business that might come in, another railroad business would have to spend money and rent the railroad tracks off Burlington Northern. They would have to give Burlington Northern money to allow them to use their railroad tracks because they can't build new ones. And this allows them to have a competitive advantage. That means they basically, another company can't come in and just try and beat them. The next competitive advantage, or moat, is a brand moat. Now, I'm going to use a company that Warren Buffett owns again, but this is a great example of a brand moat. You can think of a brand moat you can think of loads of brand moats actually. When you go into a shop or a supermarket, and would you ever just think about a brand as being a product? So instead of thinking, like, if you were going into a supermarket and you wanted Coca-Cola, for example, just any sort of home brand Coke, you wouldn't think of a home brand Coke, you would think of Coca-Cola. And the same goes with, it's not as strong, but it's similar. If you were thinking of like an orange fizzy drink, most people think of Fanta. So that instantly, that brand moat is instilled within people's brains because they don't classify the product, they think of the brand instantly. Yeah. So this is a great sign that someone's got a brand moat. If they signify the product straight away with that brand, that signifies that they have a brand moat. Now, we could think of Coca-Cola as having an extremely strong brand moat because when you go in a supermarket, everyone always goes straight for a Coca-Cola, unless they're on a budget and they want to go for the cheaper alternative. But pretty much any restaurant, any supermarket, anywhere around the world, any cafe, pretty much all of them sell Coca-Cola. Yeah. So, and you could argue Pepsi's got a very similar, and the duopoly in the marketplace. However, still arguably Coca-Cola is more instilled in people's brain than even Pepsi is. And this is a great sign of a brand moat, and it keeps making consumers come back because they reference, even though it's a little bit more money, people were willing to spend the money because they know what to expect from that brand. This is probably one of the moats that is actually one of the strongest, but it's also one of the hardest to identify, in the sense that most people think, oh, it's got a brand moat, but actually you need to make sure it definitely does, because if it doesn't, brand moats can disappear very, very quickly due to like reputation issues or anything within the company. But if you have a proper strong brand moat, such as Coca-Cola's brand moat, that it's built over 100 years, yeah, it can be the strongest the strongest moat that you can actually have, because once something's in the consumer's brains, or they believe something, it's actually quite hard to make them unbelieve that. The next competitive advantage, or moat, I'd like to speak about is probably one of the most relevant in today's age, which is a network effect. Now, a network effect, the easiest way of actually describing it is through a company. So you can think of Facebook having a network effect. The fact is, more people go to Facebook, and that means it draws in more people to want to join Facebook, because if they know all their friends are already on Facebook, they're more likely to join Facebook than they are to go to a different site, and then one where none of their friends is on, and try and get all their friends to join this one social media platform, than they are just to join the one that everyone's already on. And then once everyone's already on a platform, it's a lot harder for these people to detach themselves from it and go onto a different platform. So that's why the likes of Facebook or Instagram have been popular for years on years and years, because everyone's already on them. So it's like an ecosystem that's already built in. And then what it also allows them to do, it allows them to target ads on these platforms usually. And this means that all the brands that want to target ads online, they're more likely to come to the websites where they've already got a massive audience, where they've already got a lot of people on them. And this allows them to have this flywheel effect of more people joining, means more people in the future are going to join and are more likely to stay on the platform. And it also means that brands are more likely to have their advertisement budget spent on these websites because they know they can hit the correct audience that they want to hit. So this is probably one of the most crucial and the most relevant ones today, because we've got so much going on in terms of the internet, which is where the network effect actually works really well. Next competitive advantage that we need to talk about has been one that's been relevant for hundreds of years, all the way back to the Industrial Revolution and previous to that, and that's scaled economies. And the idea of that is, as a company gets bigger and bigger and bigger, it allows them to become more efficient and reduce the cost of their manufacturing, or it allows them to buy more goods in bulk. And then what this allows them to do is lower prices and lower their cost to produce an item, but keep prices to sell it still at the same level as all the other competition, but it allows them to have a higher margin. You can think of this like Amazon. So Amazon are able to sell us goods at a higher margin to themselves than other small retailers because of the sheer size of the company. Leading on from scaled economies, we've got a concept that was very much popularised by Nick Sleep, a very famous value investor from the UK, and he popularised something called scaled economies shared. Now, a very key example of this is Costco. So the idea is these companies have great scaled economies, so they have very much of a cost advantage over other companies because they can buy in bulk and etc., like I've spoken about before. But instead of passing this on by having higher margins for themselves, they end up passing this price decrease, these savings, onto the customer, therefore reducing how much the customer pays for an item. A key example of this with Costco is because they keep their prices down by having not that many staff, because they allow to have all their items come on big pallets. They come in large quantities, that way they don't have to unpack. They keep their stores as a warehouse sort of format, so that's very cheap for them just to load straight onto the shelves. And the high quantities that they sell allow them to have a discounted rate when they're buying from suppliers. So instead of actually passing these costs, this cost saving, and having it as high margins for themselves, they actually pass these cost savings on to the consumer in the aspect of actually lowering prices for the consumer. Costco is a little bit different because they have a membership plan, which they pretty much make all their profit off selling memberships, and they end up sending all of the cost savings that they get onto the customer in the eyes of lower prices. This means that the customer thinks they're getting a better deal, which they are getting a better deal, and they're more likely to come and shop at the shop again and again and again. And I mean, if you've ever been to any Costco, I know here in the UK they are permanently rammed, and that's because people love getting a good deal, and that's exactly what they are getting. And last but not least, one of the key competitive advantage or moats that you'll see quite a lot in commodity businesses is the low cost producer. Now this is a tricky one because now whilst a low cost producer is a competitive advantage because they're beating everyone else, it can quite quickly turn into a complete spiral of like death effectively, because all the companies try and compete with each other to lower their prices, and as they all lower the prices, eventually it gets to a price where no one's making profit, and then they all either load up on debt or they go bankrupt or some sort of correction has to happen. So you need to be really careful when looking at low cost producers that they can sustain the low cost, i.e. they might have they may have some sort of access to a commodity from a company, from a mine maybe, that other companies can't get access to, and it allows them to have this low cost. Or they may have real big like scaled production, which allows them to save on production of this commodity and actually allows them to have the low cost. So it kind of links a little bit with scaled economies shared. This is one where, if I'm honest, I don't really look into too much, just because it's very hard to guarantee 10 years out that they're still going to be the low cost producer, and that other companies aren't just going to slash their own profits just to try and compete. And then what happens is they just keep lowering prices until no one's making any profit. Now, I hope this video has been helpful and it helped you keep models in your head when analysing companies. You can keep an eye out for these sort of different competitive advantages and see if the companies that you're analysing actually have these competitive advantages. And if they do, and you truly do think it's long lasting, then it's a great example of a company that could be a potential investment for yourself, and that it will compound capital at a high rate of return for the foreseeable long-term future. So if you've liked this video, please give it a like and drop a comment down below. And if you'd like to see more content like this, please drop me a subscribe, and I'll see you in the next video. Bye.